Hello and welcome. I'm John Connell and I'm the founder of The Knowledge, Britain's fastest growing daily current affairs newsletter. And I'm delighted to be hosting The Knowledge's briefing with Netwealth, one of Britain's most exciting and innovative wealth management firms, founded back in 2016. We'll be talking about the first Labour budget in 14 years and the immediate implications for your investments and financial plans. And with me today, I've got Charlotte Ransom, the CEO of Netwealth, and Gerard, Lyons, the economics guru, the chief economic strategist. Now, Charlotte has had over 30 years experience in private wealth management and investment banking, 20 of those working at Goldman Sachs, where she was a partner. And Gerard is a much respected British economist. So I think we'll start with you, Gerard, and just what we want. But just actually, before I do, I should say that if you'd like to ask a question today, please just email it to us, contact@netwealth.com, and we'll do our best to answer as many questions as we can. And afterwards, the Netwealth team will post answers over the next few days to any questions we can't answer today on www.netwealth.com. Please also note that none of the discussion today should be considered personal finance planning advice. This would need to be accessed by contacting Netwealth directly. So, okay, Gerard, back to the budget. What's your overall assessment of this budget?
Well, hello, John. Well, this was a tax, spend and borrow budget. Labour has inherited a sort of moderately improving economy, but the UK is still a sort of low growth, low productivity, low wage economy. But in addition, Labour inherited a fiscal position that's not particularly good, debt levels very high. From an economic perspective, the way to address such a debt position is a combination of factors. Ideally, you grow the economy, or you reform public services, control spending, raise taxes, or borrow. Or you could do more than one of those at any one time. This budget doesn't really boost economic growth. In fact, as we'll probably talk about later, the growth picture is still pretty poor even after the budget measures have fed through. The Chancellor did talk about reforming the public sector, but this is more tinkering at the edges. So growth and reform aren't really there at centre stage in this budget, despite what was said in the Commons on Wednesday.
Yeah, this was always supposed to have been a pro-growth budget. We were told we were going to have a lot of emphasis on growth. So how do you see this in historical terms then? I mean, is it like 1945 or 1964 or 1997? I mean, where would you place this budget in historical terms, Gerard?
Yeah, well, the Chancellor did beginning her speech by talking about this in historical terms, but those 3 years were mentioned because those were years when Labour assumed power from the Conservatives. But there was also another year when Labour assumed power from the Conservatives, and the Chancellor didn't actually mention that year, and that was 1974. Now, in actual fact, I think that's the most relevant one from a historic context in terms of the years when Labour assumed power.
So we're back to the 1970s. This is a budget taking us back to the 1970s in some ways.
Well, I wouldn't say it's taken us back, but the domestic and the global context is a really challenging one. Then in the 70s, inflation was to the fore. And of course, in the mid-70s, the UK had to go cap in hand to the International Monetary Fund. That's not going to happen this time, so don't worry. But it's still a very difficult backdrop. Now the worry is more about growth, and the worry also is about the high level of debt. Indeed, since Wednesday, people have been talking about the Norman Lamont budget of 1993, because this budget announced a big increase in taxation. And the last time we had such a big increase in taxation was in 1993 with Norman Lamont. Then, of course, Lamont raised taxes, but at the same time, interest rates were falling sharply and the pound was weaker and the economy benefited from that. But just coming back to this budget to talk about the stark reality of the tax, spend and borrow. Spending is not being curbed. In fact, spending is set to rise sharply. In fact, spending as a result of this budget is going to be higher by on average £69 billion a year, each year for the rest of this decade. Now, spending has to be financed, especially if you're not growing the economy. You need to finance it either through higher taxes or increased borrowing. In fact, we've got both of those as a result of this budget. The spending, 2/3 of the spending increase is going to go on current government spending, a third is going to go on capital spending, and of that 69 billion, there's going to be an additional 36 billion pounds of tax each year, and there's going to be an additional 32 billion pounds or so of borrowing from the financial markets each year. So it's a tax, a spend and borrow budget. And the historical analogy is very much with the difficult times in the 70s and 1974. And bear in mind Norman Lamont's tax raising budget in 1993, and whether you can have other measures to get growth moving along.
So, is there anything, listening to you, is there anything that you liked about this budget? Do you think is good about this budget? I see Juliet Samuel in the Times, for example, says that if some of this money is spent wisely, it might help consumer demand, for example. Now, what do you think about the positive aspects?
I completely agree. The real positive about this budget was the Chancellor's focus on investment. I'm sad to say that I wrote an article in the Times back in 1991. I was very, very young at the time, I have to say, saying we need to boost public investment, spending on R&D, and how even then we were underperforming our major competitors. Here we are all that time later, and it still is an issue. So the Chancellor, I think, was positive to focus on investment. And I really think that's a real takeaway. We need to boost investment on infrastructure, on the green agenda, and also boost the supply side of the economy. The challenge, though, is the economic benefit of that investment takes time to feed through. But to actually fund the investment, you add to borrowing in the near term. On top of that, as we know, the government isn't always good at choosing the best place to invest. And also, if you look at HS2, it can add to costs very quickly. And in an economy like Britain, actually, sometimes the best investment can be actually just investing in your current stock, and that's more current consumption. But nonetheless, we need to see investment. But the key thing, if it is to be a real positive, is if that public investment not only chooses the right things, as you've mentioned, but also if it encourages the private sector to invest. Because for investment truly to pick up, it can't just be the government. You need to incentivize the private sector. And also you need the financial sector, the city, to play its part. There's lots of funding gaps in the UK, a lack of patient capital, a lack of lending to small and medium-sized firms. And the real challenge, though, is that while all these are positives, the OBR, the official forecaster, in its forecast to accompany the budget, isn't convinced that growth will really benefit as a result. It actually talks about some of the crowding out. So instead of crowding in, as the Chancellor mentioned in the Commons on Wednesday, the fear in some economists' views is that it might discourage that private sector investment. But nonetheless, the big positive is the focus on investment.
Okay, so you mentioned that the private investment, so the growth thing. What's your view? I mean, do you think that this budget will encourage growth? Do you think it will help the private sector in any way?
Well, the real challenge is the tax component. Taxes are rising significantly. The Chancellor didn't want to increase the taxes on working people, as we've heard so often. But there is a huge tax increase in this budget. It's particularly on national insurance contributions for employers. And then there's a wealth of stealth taxes that Charlotte will touch on in a moment. But small and medium-sized firms in particular, I think, are going to be clobbered by the tax increases. Now, to give you an idea, the government is assuming £25 billion of tax take from those national insurance increases. But the OBR, the official forecaster, by the end of the 5 years, thinks that the government will not be able to claw all that tax take. Because what tends to happen is that firms pass those costs on. 4/5 of those cost increases from employers' national insurance going up will go onto their workers. That's why national insurance on employers is called a tax on jobs. And maybe 1/5 of it will either be squeezed in profit margins or go on to higher prices. So it's a very difficult backdrop. So the growth benefit is very much like a sugar rush in the next few years. The OBR, and it's only a forecast, it might be wrong, but I think their view sounds consistent. There will be a boost to growth over the next year and a half or so. But as one looks further ahead, that growth dynamic starts to unwind. And indeed, the real worry in this budget is because of those tax increases, the underlying assumption, and again, it might be too pessimistic, is that over the next couple of years, household incomes really rise quite significantly. But once you move 2 years ahead to 2026 and 2027, household incomes are not expected to rise too much. So it comes back to the fundamental issue, John. Before the 2008 global financial crisis, this economy was growing trend rate 2.4% and indeed doubling in size every 24, 25 years or so. Now our trend rate of growth is so slow, this economy doubles in size, take out inflation, at half that rate, maybe every 50 years or so. Our expectations haven't changed. People are getting older, that's more pressure on public services. There's the geopolitical tensions leading to upward pressure on defense budgets. So at the same time as there's those demands for increased public spending, at the same time, this economy is not growing at the pace we were once used to, and we haven't cut our cloth accordingly, which is why the markets keep thinking, where's the growth going to come from, and when are you going to get the debt under control?
Thank you, Gerard. I think I should bring in Charlotte at this point. I think that's a very interesting overview. But what are your thoughts, Charlotte, about this, particularly the way it's going to affect us, I mean, individuals, and the way this budget will affect all of us?
Yes, thank you, John. And it's great to be able to have this discussion so soon after the budget. And as Gerard has been talking about, huge tax increases for employers, but also for individuals. And I think maybe we should start with a slide just to highlight the key areas of the budget that are affecting individuals and families. I want to start with pensions because charging inheritance tax on defined contribution pensions after death is a very significant change, and that's going to mean a certain amount of replanning is required to be ready for the change that comes in April 2027. In fact, we had an earlier webinar this week and we saw more questions related to this particular point than any other aspect of the budget, because pensions have been used as such a useful estate planning vehicle for those either who don't fully draw on their pensions during their lifetime, or for others who may never even touch their pension during their lifetime. It's been a very effective tax-free pot to pass on whatever assets remain on death. I think, though, it is really important to remember that pensions remain a very important vehicle, whether you're still working towards retirement or if you're in retirement. It is a relief that the tax-free lump sum hasn't been changed, nor has it been capped. I think it is worth pointing out that now, once over the age of 75, it will probably make more sense to take the tax-free lump sum than it did in the past, given that it now sits inside your estate from a tax perspective. We've also seen that the lifetime allowance, which was talked about a lot in the past, that hasn't been reimposed, and there isn't going to be a change to the tax relief available when paying into pensions. So all in all, pensions will remain a really tax efficient savings vehicle because investment returns will continue to grow tax free when they're inside the pension wrapper. So I think the question will be more related to how and when to draw from a pension in the context of other assets, and also whether or not it should be used for gifting earlier than it might have been before this change that was brought in by the budget. If we then think about inheritance tax, if we go beyond the change to pensions, there have been some other important changes that have been made to the IHT rules. I think in particular, the removal of tax relief on agricultural business property and AIM stocks, which is now going to be capped at £1 million as of April 2026. So from then on, these assets are going to move into an effective tax rate of 20%. And we're already seeing from interactions with clients that this is going to have a meaningful impact on land and business owners who may want to rethink the ownership structure for their businesses in order to avoid what could be a significantly higher IHT bill than had previously been calculated. Another way that the IHT bill is likely to be increased is through the extension of what's known as the nil rate band allowance. That cap is extending from 2028 to 2030. So the nil rate band applies to an individual's assets on death for the first £325,000 and then a further £175,000 if property is passed on to children or grandchildren. And what that means for a couple is that you can save up to, or you can have up to £1 million protected from inheritance tax. However, with inflation and growth, freezing that cap for an additional 2 years is probably going to mean that it'll be breached by many more families, with IHT being charged at 40% above the nil rate band. The third point is around capital gains tax, and there's been all sorts of debate previous to the budget about what would happen to capital gains tax. What we saw is that basic rate CGT went from 10 to 18%, and the higher rate moves up from 20 to 24%. Overall, that was a smaller increase than had been trailed in the press, and so it probably comes as somewhat of a relief. There's also no change to primary residences, which will still be exempt from capital gains tax, and no change to CGT on second homes. And then the annual exemption will also remain frozen at £3,000. It perhaps is worth pointing out that while spouses can make transfers between themselves without a CGT tax penalty, it is a particularly penal tax for unmarried couples who will pay CGT on any transfers between them. So a point now on stamp duty, because there's been a 2% increase to the current 3% premium for the purchase of second homes. And it's interesting because owning second homes, or particularly houses for buy to let, has gradually become a less attractive vehicle for growing one's wealth. The tax benefits have been eroded over time, as many people will already know. And then this increase to the stamp duty premium will simply make it just that bit less attractive. And I think it does raise a really interesting question over property versus pensions for retirement. So we often hear people say that they think about property as an alternative to saving into a pension. And I think that debate is certainly going to be worth having as property investments become less attractive over time. And then the last point here is the VAT payable on private school fees. This has obviously been talked about quite a lot. It's going to mean an increase of up to 20% on fees. They're already extremely high, and as of Jan 2025, we're going to see that increase with another increase quite likely in the new school term of September 2025. And we know that this is problematic for lots of parents. We see a number of grandparents are coming forward to try to help soften the blow. I think the real point about all of these different aspects that we've just sort of summarized here is the absolute key to dealing with all of the changes is to understand what your different pools of wealth can do for you, both in terms of your own living costs and the needs that you're going to have during your lifetime, and then also what you can afford for your gifting plans for either children or for grandchildren.
Thank you, Charlotte. That's really good on the details for individuals. And I want to come back now to Gerard. I mean, one of the things you were talking about is capital gains tax, and I was having a conversation before the budget. Yes, the expectations were that the top rate would go beyond what they put it. But so my question really to you, Gerard, is this the bad news now? Has it got out of the way this year, or are we going to be back on the treadmill next year with increases to CJT and other things, the other things that Charlotte's been talking about? What do you think?
Yeah. Well, it's a really challenging question because obviously it depends on so many factors. But I feel confident in saying that the pressures are unfortunately going to remain on the public finances for some time. For instance, next year we have.
I mean, it's going to get worse.
I think these challenges and the issues that Charlotte's touched on are going to be recurring themes. And clearly, given that the government has ruled out raising income tax, capital gains, corporation tax, VAT, and national insurance on workers, those are big tax raising areas. And that puts the pressure on all the other areas if the pressure on public finances remain. Now, it has to be said, in the budget, the Chancellor did make some welcome measures or introduce some welcome measures. For instance, from 2028 onwards, she is now going to increase income tax allowances in line with inflation. So that ends 7 years of fiscal drag. Also, I think it was positive that she extended the 5p cut in fuel duty, which will help rural areas and those dependent on the cars. She also raised the minimum wage by more than the rate of inflation to take into account the cost of living crisis. But of course, that will add to pressure on firms' wage bills. So there are positives. But I think, coming back to your question, I think there are issues here. Really, three things come to mind. One, we have a comprehensive spending review next year. And some of the non-ring-fenced areas, so outside of health, outside of education, areas need more money. And that in turn implies either taxes go up or borrowing goes up. At the same time, if growth disappoints in future years, that will bring the problem very much back to staring the Chancellor in the face. And the third point on top of that is that, quite frankly, and it's not peculiar to Rachel Reeves, Chancellors can't help but to interfere. There were 17 tax and spending measures in this budget. Now, to be frank, in his 4 fiscal statements, budgets and autumn statements, Jeremy Hunt was almost up to 70 on each occasion. So governments, instead of moving to simplicity, we keep moving to complexity. So when you add that up, upward pressure on spending, the risk that growth could disappoint, and the tax and spending gestures and the pressures that any chancellor faces from all sides, means that the issues that Charlotte touched on are likely to not be one-offs, but recurring themes.
Yeah. So what do the markets think? I mean, how have they reacted? Do they take the same view as you?
Well, markets are going through an evolution. Obviously, the UK needs to be seen in an international context. For instance, a couple of years ago, when we had the disastrous mini budget, markets then were really focused on inflation. Then they were spooked by the anti-inflation credibility and the fact that they were not expecting those tax cuts and those measures that came along. To her credit, Rachel Reeves kept the markets on side. And any shocks on Wednesday were more those pleasant surprises about income tax allowances.
They'd all been trailed so much in advance.
Yeah, trailed. But markets are, absolutely, but markets are moving from evolution. So a couple of years ago, the focus was inflation. Now the focus is on growth. And in the coming years, the focus will be on debt. So the question is, how will this budget impact the growth outlook? And the markets are wary about the growth picture. But the other issue that's come out is very much linked to the increased borrowing. The Debt Management Office on Wednesday came out with their new borrowing figures. And there's going to be an increase in borrowing. That means that there will be close to £300 billion of gilts being issued over next year, and an additional $3 billion of Treasury bills. So that's an incredible scale of borrowing. But since the budget, the markets have been worried, as measured by gilt yields, by the outlook for interest rates. Because
I was going to come to that. I mean, what do you think the implication, the outlook for inflation and interest rates is?
Yeah, well, this is at the heart of your previous question as well, because markets are worried about the fiscal numbers. The markets are worried about the growth numbers. Gilt yields are slightly higher than they were before the budget. And it comes down to, how things play out. On the inflation front, inflation currently is 1.7%. But the OBR in their forecasts thinks that this budget will add about 0.5% to the profile of inflation. So they're more cautious about the inflation outlook. Admittedly, it's their forecast. The Bank of England might have a slightly different one. The OBR also basically is saying that there will be a near-term bounce to growth. And then on top of that, borrowing is high. So against that backdrop, I still think interest rates, which are currently 5%, are set to fall. I think what this budget means is that it's more likely that interest rates settle around 4% or so. Maybe they could dip lower, depending on how the economy performs, to 3.5%. But the markets are now taking that more cautious view about interest rates. And that's been partly the explanation behind how markets have reacted since Wednesday. More cautious about the ability of the Bank of England to cut rates, worried about the underlying borrowing requirement that's implicit. And indeed, that borrowing requirement was there before this budget, but the budget is just because of the increased spending, it has to come from somewhere, higher taxes, higher borrowing. So in a nutshell, when one looks at markets nowadays, one has to look at them in the global context. Obviously, we have the US election next week. That's going to be big news, events in China next week. But the worry is if you have an idiosyncratic feature something particular for an economy. And the budget itself has highlighted the growth challenge for the UK. It's highlighted the debt challenge for the UK. And naturally, against that backdrop, the markets are cautious. But interest rates, coming back to your question, at 5% now, I think will trend lower. I would expect to see the Bank of England cut rates in this coming week at their next meeting. If they didn't, then that would be seen maybe by the media as a thumbs down on the budget. But I still think the current inflation profile allows scope for interest rates to come down, but rates may not fall as far as the markets previously expected because of some of the underlying measures announced on Wednesday.
So you were quoted in the Financial Times, and you said that the budget is, I think I quote accurately, the biggest wake-up call to review personal finances that we've seen in a long time. Why is that the case, Charlotte?
Well, yeah, I did make that comment because there are a large number of tax rises as we've seen. And I think one of the problems that we see time and time again in Britain is that we're all prone to putting our head in the sand if we possibly can and just sort of hoping that it's all going to be fine. And actually, we've now really been forced to think again and to think very specifically about how these changes are going to affect us. And the other thing is, it's a reminder that there are lots of things we don't have control over. And you know, as Gerard was just been pointing out, a number of those result in a higher tax environment. There's nothing we can do about that. We can plan properly, and that can make a big difference to outcomes. And the other thing we can do, and we need to be careful about, is what I call controlling the controllables. And I think this is something which I'm hoping this budget is going to heighten the focus around and help people think more carefully about. So one of those things is making sure that you're invested, to make sure that those investments are globally diversified. As you and Gerard have just been discussing, the UK very fortunately is not reacting in the same way that it did to the Liz Truss budget, but nevertheless there's the potential for some of these concerns to intensify and to see specific reactions in the UK as a result of the budget, or indeed next week on the back of the US election. So being diversified is very important. It's also absolutely critical to keep using all available tax wrappers. So as we said before, there's been a lot of focus about the fact that pensions are no longer an efficient IHT vehicle, but they are still absolutely the place that you want to be accruing tax-free investment gains, as are ISAs. And so when families think between them, it's not just, have I done my ISAs, have I used my pension allowance? It's also, is my spouse using the full allowance? Are my children, if I've got the additional cash, able to have their junior ISAs topped up to 9,000 a year? Or indeed, would I contribute to young adult children being able to put away £20,000 a year in their ISA wrappers? So we still have those very efficient tax wrappers. The third point of controlling the controllables, which in my mind is possibly the area that is least well understood and can have the biggest impact, is fees. So we continually see clients who are moving over from traditional wealth managers, where they're paying all-in fees to have those assets in their pensions and ISAs and taxable accounts managed. They're paying all-in fees of over 2%. And they often don't realize it. So sometimes people will send us portfolios and just say, please, can you just tell me how much am I paying? Because unfortunately, it is, deliberately or not, it is made very difficult for...
I don't think people do understand what fees they pay half the time. I think it's true of me. I'm absolutely right.
John, just send me your portfolio and we'll get that sorted for you. But, you know, people don't realize it. And it is actually really tricky to understand sometimes. What we know for sure is when we see people paying over 2%, we know they can save at least 1% a year in fees. And the impact of that is huge. So what I'd like to do is pull up a slide just to help explain and demonstrate what that impact is. So what we've got here is, if you have a starting amount of £1 million, so let's say that is £1 million pension pot. which is accruing tax-free. And what we have here is the difference over 10 years in terms of how much that pot will grow. So you can see that it will grow to 1.46 million if you're paying traditional wealth management fees with an all-in total cost of 2.1%. While if you pay 1% less than that for exactly the same service, that pension will grow to almost 1.6 million, which is a saving of £124,000 over 10 years. And you can see, not surprisingly, that over 20 years, that saving grows even more to a total saving of £380,000. And this is the sort of thing that really worries me, because pensions are quite often not all in the same place. People will have several pensions, potentially some of them small, some of them larger, spread around, and they've taken their eye off the ball in terms of what those all-in costs are on an investment asset that is going to be with them for decades. So this fee impact, the reason I've shown it over 10 and 20 years is because often pensions are 30 or 40 years that they are being both grown and then used for income. So incredibly important to understand that. It's probably just worth taking that same concept and applying it to something else that I talked about earlier, which is school fees. So, and again, this is a topic which lots of people have talked about. So let's just take an example of you're saving for 2 children or 2 grandchildren at a private day school. And previously, a £300,000 pot over 10 years would have covered 2 pupils with average yearly fees of £18,000. Now, that £18,000 is growing to more like £22,000 per child. And so if you had a £300,000 pot, there would actually be a shortfall now of around £35,000 if those assets were being invested with a traditional wealth manager and you were paying those higher fees. So another way to think about this is if you were able to save 1% per annum in investment fees, interestingly, that saving actually more than makes up for the higher school fees. So in fact, you don't need to think about increasing the initial lump sum. You don't need to adjust it upwards. If you know that the money that's being managed to help pay for those school fees is being done at that lower all-in cost. And again, a bit like a pension, and I know this from having had 4 children myself to think about school fee planning for, that just like a pension, school fee planning and paying takes place over multiple years. And so you can make a huge difference to your own financial capabilities just by ensuring your assets aren't being hammered by those high fees that are being charged by the traditional wealth management community. And I think to round that off, again, when we think about the news that was delivered in the budget, and quite a lot of it being bad news from a personal financial consumer standpoint, it's absolutely right to say there are some things that we can control and that we can make a difference with if we actually focus our minds and start making sure that we know we're doing this in the most efficient way.
Thank you, Charlotte. Well, we've had lots of questions from readers, so I think we've got time for a few of those now. And one for you, Charlotte, which is, given what you said, do the tax changes mean that we should be considering, I mean, beyond the fees point and everything else, different strategies for investing in the future? I mean, what do you have any broader thoughts about, whether the strategies should change?
Yeah, so it's very interesting. We have had lots of questions about inheritance tax planning and
Sure.
optimizing tax liabilities, obviously. As we've talked about, the changes to pension treatment are one of the reasons this has become kind of front of mind now, because you can't rely on them as being tax-free any longer. I think one of the things that is really critical is to consider how you're thinking about gifting. And something that you may have thought about less before And if this is something that you really are keen to address, whether it's for young adult children or indeed grandchildren, and in order to do that, you absolutely need to understand how much you can afford to gift in your lifetime, and to understand if you can get it started sooner rather than later. So you still have this notion of an potentially exempt transfer, a PET, which means that if you gift and you live for a further 7 years, all of that money falls outside of your estate for inheritance tax. And I think because now you don't have that pension buffer, that's the sort of thing which is going to be quite relevant in, as we said, bringing some of that thinking forward. But in order to do that, you really need, first of all, to understand exactly how much you have at your disposal and how that will potentially impact your own income and your own needs. The last thing you want to be doing is giving away more than you should and then having to ask your children to look after you at the point that
Absolutely.
you reach really late age. And then I think the other thing sort of around the planning part of this is which assets you draw from over your lifetime. Because again, you might not have touched your pension at all before. It may still be the last thing that you want to touch, but I think that question is something that is worth sitting down with an advisor and discussing, because across everything you have your GIA, your taxable accounts, you then have these tax-free wrappers we've talked about, ISAs, pensions, and you want to think about the mix of those, your age, your level of wealth, and then to really make sure that you're going to draw from those pots in, in an order that makes most sense.
Question for you, Gerard, although actually really for both of you, but if there was one big policy that you would like to see announced in the budget but wasn't, or that you'd like to see in a future budget, do you have any thoughts of what that might be?
Well, my feeling is that budgets need to be much simpler. It comes back to one of those earlier points about this budget having 70 tax and spending measures. We often talk about the level of tax, but a key issue often raised by businesses and also by people is about the need for simplicity. If we actually had a more simple tax system, that would ease many of the problems and the issues. In fact, we've made the whole tax code very complex. To give you one clear example, for instance, in this budget, or indeed in any budget, I'd like to see a removal of those high marginal tax rates that sometimes hit people very hard, depending on where they are on the income spectrum. For instance, we saw the issue in recent years when there was changes to child benefit. So people were seeing very high marginal tax rates when that was being clawed back. And also, if you're lucky enough to be earning more than £100,000 a year, you suddenly go to a much higher rate of marginal tax. In the Treasury, they used to talk about it as the Manhattan Skyline, that you would have marginal tax rate that go along up, down, up, down. What you really want to have is a smooth process. So that would be the key thing. And I think it should be a stepping stone, not only to removing those excessive high marginal tax rates, but a stepping stone towards a simpler and easier to understand tax system.
And sort of finally, but has this budget delivered enough to make you optimistic about economic growth in the future, British future?
I often say Britain's biggest export and its best export is its pessimism. We're always so critical, so down on ourselves. Yes.
We are.
What we really need to do is to achieve what the Chancellor set out as her aim, much higher growth. But you don't necessarily do that through increased taxation and increased borrowing to fund increased spending. As I said earlier on, the higher public investment is really very positive. But when one looks at the outlook for any economy, not just Britain, but any other economy, and indeed at any time, the outlook depends on the interaction between the economic fundamentals, the policy, and confidence. The fundamentals suggest we have a challenge on growth and on debt. Policy needs to be more constructive towards growth and at some stage needs to address the debt challenge head on. The challenge for economists is trying to fathom where confidence lies, because it's the most difficult thing to predict. And it's still unclear a few days after the budget whether it's had the impact it should have had in terms of boosting confidence, not just amongst consumers, but amongst investors as well. So we need to address that sort of growth challenge and address the underlying debt issue as well.
And Charlotte, last word for you. For investors, I mean, what's your overall verdict? Could have been much worse if everybody's careful, looks at things like the fees and the points you raised. Actually, it could have been a worse budget. What's your feeling?
Yeah, I definitely echo Gerard's thoughts about the fact that this often doesn't seem simple. But if there were to be a simple takeaway from this budget, it is without question, we're all going to feel a bit poorer. But there are definitely things that you can do to soften that blow quite considerably. And so, in my view, there has never been a clearer signal to make sure those financial plans are in place and just to take the time to extract our heads from the sand and really just make sure that you're thinking about those different things that we've covered and put yourself and your family in the best possible position. I think as Jerry was saying, it's quite possible that this will be ongoing for some years. That's the other thing. So the sooner you can start to think about the different things that we've been discussing today and get yourself in a position where you're confident that you've got the right plans in place and can then adjust and tweak should there be further changes in the future. I think that's the best that we could hope for at this stage. And you know, people will be feeling probably, hopefully, better than they might have done once they are confident they've got a good plan in place.
Thank you. And thank you both. That's really illuminating and really helpful. We're over time, I'm afraid, but I do hope that today's briefing with Netwealth, with Charlotte and Gerard, I hope that's been helpful. And if you haven't had your question answered today, please look at www.netwealth.com over the next few days, and you'll see that the team will be answering many of the questions that the budget has raised. And please don't forget that regulations prohibit us from giving financial advice during this webinar. Instead, you should contact advice@netwealth.com if you'd like to speak to one of their advisors. So thank you so much for joining us. And thank you again, Charlotte and Gerard. And I hope it's been a useful overview and you've got some key takeaways from this historic budget and potential action points. Thank you.
Thank you. Goodbye.